On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice and it doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Please engage with us. We love to get feedback, questions, and comments on this material, and if you enjoy it, please rate it, or even better, share it with a friend or colleague. Intra-year share market drawdowns, which is financial jargon for declines, like the one we've seen this year, aren't uncommon. In fact, a fall of at least 5% at some point during any given year is extremely likely. In the 76 calendar years since 1950, there have been just 5 occasions where we haven't seen that. During the other 71 years, so that's 93% of the time, the S&P 500 index in the United States has at some point found itself at least 5% below its peak from the previous 12 months. We've seen double-digit drawdowns in almost 2/3 of years, and the average decline for all of those 76 years since 1950 has been 16.1%. Now, I suspect that is a lot higher than many of you might have expected it to be, and it isn't a world away from the 18.9% fall that the index suffered this year when it was at its weakest point. Now, that's not to say that the volatility is behind us or that US shares won't retest those lows we saw in early April and possibly go even lower. They might, but my point is that while the reasons behind these declines are always different, the declines themselves, the drawdowns, are par for the course. Since 1950, US shares have delivered positive returns in 59 out of 76 years. That's a 78% hit rate. But even in those up years, the average drawdown was still 13.5%. Volatility is the rule rather than the exception, and financial markets have historically performed very well in the long term in spite of this. Over these 8 decades, the S&P 500 index, including dividends that were reinvested rather than spent, has delivered an annual return of 11% per annum. That's very impressive, and it means that an investor would have doubled their money every 6.6 years on average. The world has thrown countless curveballs at investors during that time. Even in the last 30 years, we've had the September 11 terrorist attacks, numerous wars, a US housing crash, a global pandemic, and 3 recessions. During those 3 decades, I can point to 15 occasions where the S&P 500 fell by more than 10%, including 7 instances where it was down more heavily than it was this year at its weakest point. 2 of those times, the market was cut in half, sinking close to 50%, but the returns over that entire period have still been highly attractive. There is always a long list of things to fret about and plenty of reasons to sell. Today it's US trade policy and what that might do to economic activity and corporate earnings, while 5 years ago it was the pandemic. Before that, we had Brexit, we had a slumping Chinese economy, we had the European debt crisis, and numerous US government shutdowns. Go back further and you'll find the GFC, the dot-com bubble, and the Asian banking crisis. There's always something. In between all of those events, it's been overheated house prices and share markets where values simply fell because they went up too much in the lead up. Despite all of that, and everything else that I haven't mentioned, the market still has a flawless track record of recovering and moving on to bigger and better things. One of my favourite quotes comes from financial author Morgan Housel. He was talking about the reward for long-term investors being superior returns, and he said that volatility was simply the price of admission. Thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.